right, final panel of the night. The TradFi DeFi institutions Convergence. Um, we have amazing panelists. If you can briefly introduce yourselves.
Yeah, so Eli Cohen, I'm the Chief Legal Officer at Centrifuge, which is an RWA tokenization platform.
Hey, my name is Misha. Co-founder Symbiotic Universal Staking Framework.
Mark Phillips, co-founder of Grove Labs and Steakhouse Financial for building credit and liquidity infrastructure for DeFi.
All right, so we've been talking about how DeFi and TradFi is converging, but exactly which use cases are really taking off right now, Eli?
Yeah, I think there's two questions really in there. So, I think from an issuer perspective, everything is taking off. I think the issuers from TradFi want to be involved as much as possible in all aspects of DeFi. We see interest from all of the main asset managers who we talk to issue securities tokens or other types of tokens into the market, stable coins, into the DeFi markets, take advantage of the new investor base, but you don't really see the institutions much on the buy side. The institutions are just on the sell side for the moment. So, I think you can, in one way, you can say that there are DeFi institutions like Sky, which is kind of an institutional investor in many ways. I'm sure Mark will talk more about that. But the TradFi institutions, we don't see them on the buy side yet. So the use case is really on the sell side.
I agree. Well, I would say, tokenization in terms of T-bills, it started from T-bills, but will close followed by more complex projects and private credit. Because once it became, once crypto became closer to being regulated, right? People kind of realized that we have like $1 trillion sitting there doing nothing, right, and available to be utilized in an actual traditional finance, right? So I expect this to be the biggest one, I think, for a while, and then we'll get into more complicated territory that we'll discuss further, I guess, after this.
Yeah, we've seen like a ton of growth between tokenized money market funds and tokenized treasuries for the past year. So those have gone up over 3x compared to last year at this point in time. And we're also seeing a lot of private credit asset managers also tokenizing funds, bringing them on churn like Apollo, BlackRock, etc. But there's also been a kind of new proliferation of new types of credit assets. One of the more recent products is called USD AI. They're like tokenizing GB loans, essentially. Also a framework-backed company. On top of that, there's also another solar deepen project called Daylight that's tokenizing solar power purchase agreements. So there's really been kind of a next layer of innovation coming outside of just existing tokenized assets and securities. Now people are starting to experiment with what if I could create some sort of decentralized network that can benefit from the liquidity, permissionlessness, wilderness of DeFi, and tokenize that, bring that on chain. And I think there's gonna be a ton of these new assets in the next 3 to 6 months. To me, something like Maple or Athena is really considered, or should be considered, an RWA, because a lot of the assets are basically held off chain. But yeah, I think we're gonna see a lot more of these more DeFi native forms of RWAs rather than just pure securities as well, the tokenized T-bills and stuff that Eli works on.
I'd love the thoughts on the rest of the panel on this, because it's not such a consensus view, right? I think the consensus right now is the tokenized assets that do well on chain are the most liquid ones. So obviously stable coins, the most liquid, US dollar has done really well. T-bills have done really well. Money market funds, recently US equities, there's been a proliferation of projects around this. But these are more exotic asset types that don't have liquidity. Maybe it's not so obvious or so straightforward that they'll find the market. What do you guys think?
I mean, there's always a trade-off between liquidity and yield, right? So, if you're going to move up the yield curve, which a lot of people are trying to do or want to do, you're going to give up a lot on the liquidity side. That's just, that's a given. So, if you move into a private credit instrument, you're going to get a much better yield, but you're going to lose your liquidity. And I think we see products like that. I mean, the Apollo funds, the ones that that Securitize has at Acrid, and our fund, our Apollo fund at Centrifuge are both doing pretty well. I mean, there's a big demand for that kind of product, even though there's liquidity is very, very limited, but the yield is very high. So there are definitely buy side investors in the DeFi markets that want to have or part of their portfolio be a high yield, low liquidity product to pair along with the money market funds, the treasuries, the stable coins, which are much more liquid. So you can always keep a portion of your portfolio in a less liquid asset if you want to move up the yield curve.
Yeah, the industry kind of knows how to handle like low liquidity, right? We've been doing this for a while, and yeah, for us to basically make it more liquid and unlocks shorter, we need to first create a product with like somewhat homogeneous risk profile, right? So we can build a stable coin on some derivatives on top of that and just call it a day. But it's too early, and yeah, the products with the longer lockup period have a hard time acquiring capital right now, because yeah, like we most investors can't price them yet, and the lock in Bitcoin for like 6 months when it can drop to like 50% of its current value, it's kind of scary. So I think we don't like need to invent a lot of new stuff. We just need for this to play for some time, just for people to better understand the mechanics of it all. So yeah, I think it's just gonna stay for a while, and then we'll just create some like derivative products on top of that to cater to people that want to have like a early, the more opportunity to get out early.
Yeah, I think there's kind of like a barbell of like, yes, yield seekers in crypto. There's people that like really value liquidity like above all else. So they'll deposit into something that's yielding less than treasuries, even though it's like slightly riskier, but it's instantly atomically liquid. So if there's like a hot ICO or token or trade or something, they can immediately get into it rather than like waiting T+1 to get their capital back. So you kind of, I think you might see this more and more in terms of like investors valuing liquidity over, a T+1 type of product, because we're going to see more ICOs. Like we saw Plasma, we saw Mega ETH, we saw Monad. I think there's going to be a lot more. Hopefully some like higher quality app related projects rather than purely L1s and infrastructure type plays. But I think that's why you see a lot of capital that's just like depositing straight into these more liquid, atomically redeemable type of protocols. Even though like US treasuries are, obviously much less risky and stable. But until like you have like 24/7 liquidity on treasuries, which most don't have at this point in time, it may just be like a trade-off that investors are willing to take. And then kind of on the opposite end of the barbell, you have like people that are just seeking out like yield at all costs. They just want the highest yield. They don't really care about the risk. And sometimes that's worked out until like a few weeks ago when Stream Finance, Elixir, and Stables Labs blew up. So hopefully, I know you guys talked about this on the last panel, but we do need to think a lot more about like how can we like risk manage and like have more transparency around various like new like tail DeFi assets, because it's tough to kind of like go on Pendle today and see like PT dash like SXY and not really like know what it is, and then you put that on like a DeFi protocol like Morpho, and you're like looking at the Morpho vaults and you're like, I don't know what this is. Like it's PT and like a bunch of like letters and numbers and a date. I think we have a very long way to go on like the improvement of like UX still, I think, to help like articulate and be more transparent on risk for these products.
Yeah, so let's talk more about that. So you mentioned how right now there's the demand on the issuance fund from institutions. That's where most of that Convergence is coming from. Everyone wants to, it seems like, tokenize different assets on chain, but the demand from, like, buying these assets is coming more from kind of the crypto native side. Even if they are crypto institutions, like Sky might be considered, or Coinbase maybe, but not from traditional institutions. So what needs to happen for that unlock?
Yeah, I don't know. I'm not sure that there is an unlock exactly. I don't know that, for Goldman Sachs or Morgan Stanley, they're going to be putting their portfolio book into their treasury book into tokenized assets anytime soon. I think they may do, but if they do, it won't be RWA, right? Because they can get all the RWA products they want in the regular TradFi markets. So there's no real advantage yet for them to buy a tokenized treasury fund. At some point, we hope.
Sure,
that-
even if it's
yeah.
because there's like 24/7 trading, and that sort of thing that they can get.
Well, I mean, there isn't yet 24/7 trading, so that's one of the things that has to happen. So we don't have a secondary market for the tokenized treasury funds. There's no exchange where they're listed. There's no settlement system where they can be settled. Until those things are put in place, we're not even replicating what TradFi has, let alone doing better. At some point, somewhere down the road, the whole tokenization chain will get built out, and we will be able to do that, but that's probably 5, 6, 7, 10 years from now, I think.
These guys are moving at light speed compared to how they move right now, how they moved before. Yeah, we have a lot to offer, but I agree. Like there is no 24/7 trading. There is no liquidity there. There's like the compliance of it haven't been like 100% ironed out still. So yeah, I don't agree with like 5-7 years. I think we have a lot of interest that might speed things up a little bit. But yeah, it'll take a few. And we don't need to like unlock anything. We just like we figured out a year ago that it's even possible, right? I don't know, a year ago, maybe like year and a half ago, like people were still thinking some of them will go to prison just for the compliance reasons. And now we talk to like every financial institution there is, right? And like they're actually like opening the doors and like, guys, let's discuss. Right? So it'll take some time. There is no like invention that we need to do for this to happen. We just need to do a lot of steps that we kind of understand what they are. They just will take some time.
Yeah, I think it's still regulatory, especially like for that liquidity to come, you need regulatory clarity around whether decentralized DEX is a broker dealer, for example, because there's plenty of people that are willing to provide liquidity against real assets on chain, and there's huge demand for that liquidity to be there, but no one wants to do it because there is regulatory risk until there's clarity. And obviously there's been a huge change in the US in terms of administrations and their view on crypto, and we just need the new SEC basically to kind of come through and make some clarifying statements on, okay, like something like Uniswap or Aerodrome or whatever. If you have, one side T-bills tokenized, one side USDC, your LP position is not a broker dealer. You do not have to register. It's transparent. People that are trading in and out of this asset are permissioned. So there is sort of like, a walled garden to get into and play in this ecosystem. But once we have that regulatory clarity, I think it's going to be a huge unlock, and you're going to see a ton of liquidity immediately against RWAs on chain.
Okay, now let's talk about the potential downside of institutions coming to DeFi and crypto. I think so. There's a couple of pieces here. Like, one is, early on in crypto, there was a belief that crypto native companies or protocols would disrupt payments, would disrupt lending. But now it's looking more like, okay, no, like these institutions are actually adopting crypto. So fintechs are now adopting stablecoins for payment, rather than there being like, okay, like, no, like some like crypto native payments app is going to be PayPal to it. PayPal is actually using stablecoins themselves. Um, so is this kind of defeat, or is this what adoption is supposed to look like? And in the more extreme cases, you see Stripe building its own layer one tempo, which, if it doesn't come through with its promises of like down the line being open and permissionless, I think it's an actual threat to actually open up permissionless chains like Ethereum, but are trying to go after the same use case of like being the payments hub. So how do you see this tension of like, yeah, we do want mainstream adoption and institutions to come in, but what if they come in and like, like steal our stuff and like, put walls around it.
Yeah, I mean, I would say that it's not just the institutions that are trying to put walls around things, but there's a lot of projects in DeFi that are thinking with a TradFi mindset already. You can see like Ondo filing a patent for a multi-chain permissioning system. Patents, back in the day were not something that DeFi projects wanted to pursue. And so that's a way to create a moat that's going to block every other RWA protocol from being able to launch anything. So, it's the direction. It's going in both directions. But I mean, I think this is what disruption looks like. I mean, disruption means not just we take over their business. It means that they enter our business and we enter their business. Disruption goes in both directions, and it's going to be that way for quite some time. But I mean, I think in general, the more the better, right? I mean, I think it's just more validating at how useful and important the technology that has been developed in the DeFi markets, continues to be developed in the DeFi markets, to see Stripe and PayPal and Robinhood, joining this project, joining this greater project in a way, is more validating than anything else in my mind.
Yeah, like this is what success looks like. Yeah, like what did you expect? Like for them to just die? They want to join, right? Like, and crypto was always about like everyone is welcome in our temple, right? So we had like fringe minorities, we had like Vine on chain, we had like enormous amount of protocols doing different stuff. Some of it good, some of it really bad. Like we were handling like every drug sale everywhere in the world for like some time, right? And like what some people screamed like, yeah, like oh no, we are like, yeah, we provide infrastructure, right? This infrastructure is sometimes fair, sometimes not so fair, right? Like the blockchains are open, and permissionless blockchains are not immune to like manipulation, right? We have MEV, and we kind of fine with that, like with people being like abused on the regular, right? We have other things that are like, I don't know, quite scammy. Like every 2 years we have blowout like of a Terra proportion basically. And yeah, like I'm not like, I don't want like people because like it's such an interesting barrier to cross. People think that it's our first one. We actually did a lot. I remember how people hated when we moved from proof of work to proof of stake. They were like, yeah, like this actually like the oligarchies and like like really powerful entities are gonna control this one, right? Like I should be able to do it like from the comfort of my home and like use my GPUs to mine Ethereum, right? And that's growth, right? If we misstep, if it brings us to something, to some state that like the community would not like, we will have technology that like TradFi would pay for. So like even worst case scenario, they're paying for our stuff, right? We receive investments, we can hire better developers, we can hire more researchers and cryptographers and ZK people, and like and generally like it can be dangerous, yes. But like, what are we for, right? Like we will try to, well, create this transition and perform this transition in a way that's not going to be destructive to us.
Yeah, I think disruption is going to look a little different in every kind of vertical in crypto. Like we're seeing a ton of disruption for payments and remittances, for example. Those are like very clear and obvious use cases where the technology is just so obviously better that why wouldn't you use it? And that's with the regulatory clarity in the U.S., so you see like major players like Stripe and other fintechs adopting it. I think it's going to look a little different for DeFi because with DeFi, there's always like that edge risk of a protocol being hacked or exploited in some like very unique sort of like edge case. Like we saw like what was possibly the first like LLM like conceived hack with the balancer hack. And I think that, shook a lot of people because that was, protocol has been forked like 30 times. It's been around since, I think V2 is around since, I think 2021. So to have like a kind of cornerstone OG protocol hacked for a very meaningful amount of money, and when it's hacked on ETH mainnet, that capital is immediately like turned into ETH and it's gone. So, if you're talking to institutions like we are, they're like, yeah, how can we prevent that from happening? Because I can't go to my board and say, the funds were just hacked, there's nothing we can do about it. And that's going to really slow down DeFi adoption until we can come up with some sort of like fail-safe that, prevents some sort of major exploit from happening. But that's like, in my view, like the biggest problem in DeFi right now is like, how do we create some sort of mechanism to prevent like exploits from just completely killing projects? And it's also like what keeps like, I think some talent from entering the industry because they're like, yeah, like I'm like a great coder, but like I have like North Korea coming after me. I have all these black hats coming after me. We're going to pay for audits and do everything we can. But, there is always that possibility that this minor edge case can be conceived and used to exploit, steal funds. And then I'm in court for, the next decade trying to, work with the FBI and other, global police forces to recover the money. I mean, it's just such like a difficult position to be in. So I would love to see some VC funds funding some innovation around like protecting against like black hats and exploits, and a lot less on infrastructure. Except for Symbiotic.
Absolutely, yeah, and it ties back to the previous panel where we talk about alternative from like credit ratings, but to more like proactive things like protocols like setting up an insurance fund to like make users whole when things like this happen. I think that will be key for this convergence to continue deepening. Okay, to finish, I'd love to know your thoughts on in your own project, what you're excited about, what's your focus today that you'll be working on in the next couple of months.
Sure. I mean, I think like everybody else in RWA, we're working on tokenized equities. I think that's going to be the big wave coming, and it's going to be really, really game changing for the RWA space to be able to create tokenized equities, eventually maybe to list them, eventually maybe to trade them and settle them. That's going to take a little bit more time, but there's a lot of different methods that different projects are using to create a tokenized equities. There's sort of derivative instruments that people have created, different projects where you can get exposure to particular equities. There's, but for us, what we want to do is we want to create a tokenized equity that is a direct interest that the issuer issues purely in tokenized form, not in a mixed form where you've got some shares held with a broker dealer and some shares held, in tokenized form with another broker dealer maybe, but really a direct ownership interest in a token form with an issuer company from the start, really from an initial issuance standpoint. So that's what we've been working on, and we've got a couple of things coming soon that we can be hopefully announcing about that.
What are the define for that?
Yeah, one of the things that we'll try to help with is infrastructure, right? The current RWA space is kind of siloed. I go to Ondo, I go to Centrifuge, I need to choose, right? And it's kind of like, okay, it's inevitable for most of applications, but there are a lot of protocols coming online fairly soon that will have risk profiles that can be like that don't have like contamination risk between each other. So like our job is going to be to use restaking or one of these forms to help optimize the cost of capital and basically give people the opportunity to utilize multiple. right? So like if you insure something, you can still cater to instant liquidity or something like that. We already use our liquidity to support stablecoin. Insurance is coming online. There's going to be private credit. And the dream is to make it composable, not only in a way that pick and choose, but in a way that will create like similar things that we have in the reinsurance. When $1 actually participates in multiple activities at the same time.
Yeah, I'd say from Grove Labs' perspective, we're most focused right now on allocating capital, and mostly that's been into RWAs in partnership with Centrifuge. But we've also been doing some new allocations into DeFi lending protocols based around RWAs as well, like the Aave Horizon instance. But I'm probably most excited for like new, like creatively structured assets. So a couple projects I mentioned earlier, USD AI and Daylight, who are trying to create like new mechanisms using like actual real world physical collateral, like tokenizing them, bringing them on chain, and using like composability and like permissionless nature of crypto to like try and innovate something new. So like I know like how the existing credit world works. I know those products, they're great, but like I want new stuff that's interesting, structured in a way that's like crypto native, with tons of liquidity, tradability, and higher yield ideally. But yeah, just more excited for more innovation. I feel like it's finally possible in the US now.
Amazing. Well, great stuff. You know, talking about how we're bringing the traditional or like existing real world assets or assets. I hate that word real world. On chain, but also creating new ones. I think it's really exciting. And kind of the road towards getting more institutional demand for these assets and not just on the issuance side. And also what's needed again to make all of these activities safer for all participants. But yeah, just thrilled to be here at this moment in DeFi with you guys doing such amazing work to move this space forward as it grows up. A lot of us have been here since it was in its infancy, so just amazing to see us talking about Apollo and BlackRock, just like using this stuff. I didn't think it'd be here so soon, so I think you guys gave like different like really long-term timelines for things to happen, but crypto just like keeps surprising us in how quickly things move. So thanks so much.